Good evening, students. Welcome to the session. I hope you have revised what we have done in the last class. Yes or no? Any questions do you have? Good evening, Purushottam. Yes, any questions do you have with respect to the last class? We were on the presumptive taxation. In the last class, we had finished royalties, fees for technical services, interest. Royalties, we had a very elaborate discussion that computer software, if it is not giving and if there is no right to use per se in the computer software, you are merely an end user or a reseller. We saw the engineering analysis judgment that in that particular case, the computer software, even under the act, it is considered as royalty, but in the DTL, it will not be considered as a royalty. Fine. And then we had seen for the amendment to the royalty definition for the that there is an amendment in the definition of process, which includes the satellite transmission, whether or not the control, whether or not the possession is with the payer. Right? When we had seen the fees for technical services as well, managerial, technical consultancy, we had seen the judgments on technical. Technical does not mean a standard facility. It necessarily has to include the human involvement, right? So we had seen that. Mansha, that's fine. You have revised interest royalty. That's good. Good evening, Kaushiki. Yes. Okay. So that's what we saw. So that's why I'm just quickly revising, recapping with you everything. Then we had seen that whether or not the services are rendered in India, it will still qualify as royalty interest or fees for technical services, right? So that's what we had seen in the royalty, FTS and interest, right? Now we move on to the next part, which is the presumptive taxation. For presumptive taxation, we started with section 40. There's one doubt, Purushottam. 80 GGC deduction available to 44B. Yes, every deduction which is there, which is applicable to not only a resident, only those deductions will not be available. Other than that, you can claim the deduction which are available for all the individuals or for that matter the company. That deductions you can claim. So it's not that 44B will restrict any kind of deduction. So 172, you cannot claim any deduction. But for 44B, you can claim all the deductions. Is that clear? Yes or no? Okay. So I'll just quickly recap 44B and 172 before we proceed on to solve the question. Okay. So 44B is the presumptive taxation. The way we had 44AD, 44ADA, similarly, we have the 44B and several other presumptive provisions which are applicable for the non-resident. Now, 44B is a non-obstant clause. It starts with a non-obstant clause, meaning notwithstanding anything. So, it considers the profit and gains of a non-resident who is engaged in the operation of ships. Who is engaged in the operation of ships or aircraft. It is considered as 7.5%. 7.5% is considered under 44B. Is it clear? So you will consider 7.5% which is there under 44B, and in that particular case, what will happen? This will be considered as your presumptive income. This will be considered as your presumptive income. Fine. Now 7.5% of what? So we had seen that, let me take you there. So 7.5% of amount paid or payable, whether in or out of India, on account of the carriage of passengers, goods or livestock. Amount paid or payable, whether in or out of India, on behalf of the assessee for the shipments or for the carriage of passengers, goods or livestock. You can write here at any port in India. At any port in India. Fine. So 7.5% of the amount paid or payable for the shipment at any port in India, or amount received and deemed to be received in India on account of the carriage of passengers, goods, or livestock at any port outside India. At any port outside India. So both are included. The amount paid for the shipped goods, livestock, or passengers shipped at any port in India, or amount received or deemed to be received on account of the carriage of passengers, livestock, mail, or goods shipped at any port outside India. So both amounts are included in 44B. And this will include, the amount will include the demurrage or handling charges. So amount received or deemed to receive will also include the demurrage or handling charges. This is also accepted by the Madras High Court in Japan Lines Limited case. Are we clear? Now we also have section 172. Section 172 is a complete code of tax. It is a kind of mechanism that creates the charge as well as the assessment in the same year. So the income of the particular previous year is charged or assessed to tax in the same previous year. This is the exception to the rule that income of the previous year is charged or assessed to tax in the next following assessment year. So this is a complete code of tax. What does section 172 provide? Section 172 clearly provides that where a ship carries passenger, livestock, mail, or goods at a port in India, a sum equal to 7.5% of the amount paid or payable on account of the carriage shall be deemed to be the income accruing in India to the owner or charterer on account of such carriage. Are we clear? So amount paid or payable on account of the carriage to the owner or the charterer or to any person on his behalf, whether that amount is paid or payable in or out of India, shall be deemed to be the income accruing in India to the owner or charterer on account of such carriage. So this is considered to be the final income. Means no deduction will be allowed under Chapter 6A. No set-off of the losses will be allowed under Chapter 6, under the set-off and carry forward of losses. For the 44B, you will be allowed the set-off and carry forward of the losses. You will also be allowed the Chapter 6A deduction. Here, you will not be allowed under 172 any Chapter 6A deductions or set-off or carry forward of the losses, because this is deemed to be the income. So you can write here 7.5% of amount paid or payable shall be deemed to be the income. And this particular amount is deemed to be the PGBP. This is deemed to be PGBP. Are we clear? Is it clear? Even this amounts under 172 will include the demurrage charges. And under 172, your tax will be at the rate of 40% plus surcharge and cess as applicable to the foreign company. So, under the provisions of 172, a non-resident owner or charterer is allowed an option to be assessed on his total income as per 44B. If he is opting for 44B, then in that particular case, the tax already paid under 172 will be treated as the advance tax and will be adjusted against the same. Are we clear? Fine. Now let's solve a question on this. Let me give you a question. You can write down. Write down the question. Mr. A A non-resident operates an aircraft between operates a ship, not aircraft, operates a ship between Singapore and India. Fine. It is engaged in the carriage of goods shipped at Mumbai port. Shipped at Mumbai port. During the previous year, 22-23, he received the following amounts. Rupees 2 crores in India on account of carriage of passengers from Mumbai. Rupees 1 crore in India on account of carriage of goods from Mumbai. Rupees 3 crores in India on account of carriage of passengers from Singapore. Rupees 1 crore in Singapore on account of carriage of passengers from Mumbai. The total expenditure by Mr. A was rupees 6.75 crores. Compute the income chargeable under the head PGBP. Compute the income chargeable under the head PGBP. Yes. Mansha, angel tax is not applicable to non-residents. It has been made applicable from the next particular budget, which is going to be passed. It is proposed to be made applicable, which is not applicable for your examination. The judgments which are there are present in your module, Mansha. In case you would want to read it in detail, you can find these copies online on Taxman. Yes. What is the answer? Yes, correct, Kaushiki. Yes, Geeta, correct. Purushottam. Yes, correct. Okay. So here, what do we need to do? This sum is also there in your module also. Okay. So what do we need to do in this particular case? Here, all the amounts will be included. The amount paid or payable, whether in or out of India. For the carriage of goods for from the port in India, or amount received or deemed to be received from any place for the carriage from any place outside India. So all the amounts will be included, and on that you will charge 7.5%, and that will give you the answer of 52,50,000. Is it fine? So 52,50,000 will be considered as the deemed business profits. So it comes to 52,50,000. Fine. This is your PGBP. You will not get any expense deduction. So on all these amounts, you will apply 7.5%. Fine. Now see, similarly, there are other presumptive provisions as well. The shipping company was very important because there is also a provision under 172. Fine. But for others, there are just presumptive provisions which are there. The second one is for the aircraft. So this we did for the shipping company. There is second provision under 44B, 44BBA for the business of operation of aircraft. Business of operation of aircraft. Okay. So the provision applicable is 44BBA. And what is the presumptive rate? 5%. On the amount paid or payable, on the amount paid or payable, whether in India or out of India, whether in India or out of India, to or on behalf of non-resident on account of carriage of goods, livestock, passenger at any airport in India. At any airport in India. And here also you may just write it for the 44B and, because both the amounts are to be included, right? And amount received or deemed to be received, amount received or deemed to be received in India or by or on behalf of the non-resident on account of carriage at any port outside India. Carriage of, again, goods, livestock or passenger at any airport outside India. Fine. Is it clear? So this is for the aircraft. Second one is for the business of exploration of mineral oils, which is under 44BB. This is applicable to the non-resident providing services or facilities towards prospecting, extraction or production of mineral oils. Okay, so this is for the non-resident engaged in the business of providing services or facilities in connection with the extraction of the mineral oil. Prospecting for or extraction or production of mineral oil. Okay, so non-resident providing services or facilities in connection with or supplying plant and machinery. You can also write providing services or facilities in connection with or supplying plant and machinery on hire, or to be used in prospecting, extraction or production of mineral oils. Fine. What is the presumptive rate over here? It is 10%. 10% of amount paid or payable to the non-resident or on behalf of him, whether in or out of India, on account of provision of services or facilities or supply of plant and machinery. And received or deemed to be received or deemed to be received in India by or on behalf of non-resident on account of services or facilities or supply of plant and machinery used or to be used for prospecting, extraction or production of mineral oils outside India. Okay? Outside India. Fine? Yes. So 44BB is a specific provision which is applicable for the prospecting of the mineral oil. Clear? Fine? Okay. Next one which is there is under 44BBB. 44BBB, which is for the foreign company engaged in providing the services towards a turnkey project. So, okay, one more point under 44BB, which you can write down is that here under 44BBA and 44B, you did not have the option of claiming the lower profits. But under 44BB, you have the option of claiming the lower profits if you keep and maintain the books of accounts and get them audited under 44AD. See, under 44AD, 44ADA, you have an option to claim the lower profit than the 8% or 50%, provided you maintain the books of accounts and get it audited. Similarly, under 44BB, you also have the option of claiming the lower profit if you maintain the books of accounts. Under 44B and under 44BB, there is 44BBA, there is no profit, no option of claiming the lower profit. So shipping and aircraft, you do not have the option to claim the lower profit than the 7.5 and 5%, but here you can. You can claim lower profits if you maintain books of accounts and get it audited. Fine. Okay, next one is 44BBB. 44BBB is for the foreign company. See, these are for the non-resident. So this includes even a foreign company. This is also for a non-resident operation of ships on account of carriage, right? So all these include the foreign company. But the 44BBB, which is there, is only for the foreign company and not for non-resident individual. So foreign company engaged in civil construction or business of erection of plant or machinery, erection of plant and machinery, or testing or commission. In connection with the turnkey power project. Fine. In this case, what is the presumptive rate? It is 10%. 10% of the amount paid or payable, whether in or out of India, to the non-resident, to or on behalf of non-resident or foreign company, you can write here, it's not non-resident, on account of the services. Okay, on account of specified services. What are the specified services? Services of business of erection of plant and machinery, testing, commission, civil construction, all of that. Here also you have option to claim lower profits if books of accounts are maintained and audited. Fine. Any questions? Any doubt? The option to declare the lower profit is not available for 44BBA and 44B. Lower profits not available. Fine. Here also you can write down. Yes or no? Is it clear? In 44B also no deduction is allowed, Kaushiki, because this is something which is presumptive. So this is not withstanding anything. So meaning it will override all the other section. Turnkey project is kind of the projects where these constructions take place. Purushottam. So in the turnkey project, what you do is you have these entire projects where you do the construction, where you do lot of installation. So these are a project where a single contractor is hired and the project is completed in phases. Let's say, for example, these big highways which are constructed, or let's say, for example, these big government sites which are getting constructed. So these are all the turnkey projects. Kaushiki, you are saying if in point 4 passengers were of foreign city. In this example, you mean this one? In point 4, the carriage of passengers instead of from Mumbai, if it would have been from Singapore, then it would not have been considered because the amount is received outside, the passengers are from outside. Then in that particular case, if you see here, what does it say? The amount paid or payable whether in or out of India on account of carriage of passengers at any port in India. Received or deemed to be received in India. The amount should be received in India for the carriage of passengers from outside India. So if the amount was received outside India, that will not be considered, Kaushiki. Clear? Yes, any other question? Fine? Okay. Now, if you see, we had discussed while we were dealing with the taxability of royalty or FTS. If you see the tax rate for the royalties or FTS, what I said that if it is not effectively connected to the P, then the tax rate is 10% on gross basis under section 115A. right? And if it is effectively connected to P, then we have section 44DA, under which it is taxable on net basis at the rate of 40%. Now we are going to look at the section 44DA, and then we will look at section 44C. Both of these sections we are going to look at now. So it's very important, please understand. Section 44DA. Taxability of sum received, or you can write down taxability of royalties or FTS taxability of royalty or FTS. Now, what this section provides? Let's try and understand first section 44DA. So 44DA provides the computation of the income by way of royalty or FTS arising by the services provided by the non-resident. Where a non-resident carries on the business, if non-resident carries on the business or profession in India, if the non-resident carries on the business through a permanent establishment or carries on the profession through a fixed place of profession. First condition. Second, and the right property or the contract in respect of which the royalty or FTS are paid is effectively connected with P or fixed place of service. So first of all, for 44DA to be applicable, the non-resident should carry on the business through a P or should have a fixed place of service if he is carrying on the profession, and the right or the contract should be effectively connected with the P. Effectively connected means that the P is essentially performing the functions. The P is in fact playing the lead role in that contract. So the P means the branch of the non-resident. You can understand as of now, the P means the branch of the non-resident in India. That permanent establishment which is there, or the fixed place of business which is there, that is in fact engaged in. The activities are attributable to that particular branch. It's not the HO which is doing the main lead role, it is the P which is doing the main lead role. Are we clear? Then in that particular case, if this is done, then in that particular case, taxability of FTS and royalties on net basis. Taxability of FTS and royalty on net basis. Okay. Now, what is the expenditure which is allowed and what is the expenditure which is not allowed? So, expense which is not wholly or wholly and exclusively, wholly and exclusively for the P or fixed place of service. So the expenditure which is not wholly and exclusively for the P is not allowed as the deduction. Meaning what? Let's say, for example, if the head office has taken some loan, now it is paying the interest on that loan. Now, if you see, if you have done branch accounts in CPE, you would have done, obviously, right? Because of which you are here now. So if you remember in the branch accounts, if there was a common expenditure which was incurred by the head office, it used to be divided, it used to be apportioned between the different branches. So if, let's say, for example, head office has taken loan, it may be divided between all the branches based on some ratio. So that is not wholly and exclusively for P. What is wholly and exclusively for P? Let's say my permanent establishment is engaged in only providing the technical services and for which I have hired certain employees. So the salary cost is wholly and exclusively for the P. So the expense, which was, let's say, interest, is not wholly and exclusively for P. It is for all the branches out all across the globe. That will not be allowed as deduction. So the expense which is only wholly or exclusively for the P, that will be allowed as the deduction. Secondly, the amount paid by the P to the HO or any other branch other than reimbursement of actual expense. So if the amount is paid by the P to the HO, let's say the P is making the payment of, let's say, the interest to the HO. It has taken loan from the HO, it is paying the interest. That will not be allowed as a deduction. That will not be allowed as a deduction. Other than it is reimbursement. Let's say, for example, if the HO has hired the employees and HO is making the salary payment, and the P is, those employees are working for the P, and P is reimbursing that, then that will be allowed as deduction. Other than that, amount paid by P to HO will not be allowed as the deduction. Is it clear? The tax rate will be 40% as applicable to the foreign company. Further, there is a requirement to maintain books of accounts and get it audited. To maintain the books of accounts and get it audited. Fine. What will be the due date of filing the return of income for these kind of assessees? Give me the answers to both the questions. What is the due date of filing return of income? No, Kaushiki? Let me see who gives the right answer. Yes, very good, Kaushiki. Yes, Viraj, very good. Very good, Purushottam. it is 30th November and not 31st October, because if there is a P, there may be transfer pricing provisions which are applicable. So 30th November, and this will be 31st October. Very good. So you all are revising. Okay. One sum on this, one small example on this, so that you register this properly. Okay. So let's say there is ABC Inc. has operations in India. It has started an office in India. ABC Inc. has business operations in India. It has started an office in India. The ABC Inc. has entered into a contract with, let's say, RIL, to provide the designing services in respect of a new project to be started in Gujarat. Okay. The office of ABC Inc. has been looking, or you can write down, the office of ABC Inc. One second. ABC Inc. will be providing these services through its local office in India. For this purpose, it has hired 10 employees whose salaries are rupees 1 lakh each. Okay. It has also, or you can write down, one second. The salaries will be paid by ABC Inc. and would be reimbursed by the local office. The office expenses during the year amount to rupees 2 lakh. ABC Inc. has also hired has also purchased the designing software amounting to rupees 2 lakh ABC Inc. will charge rupees 50,000 to the local office for the same. However, this software will also be used by other offices of ABC. ABC Inc. has also charged common admin expense to local office amounting to rupees 1.5 lakh. The net profit after considering the above expense is rupees 10 lakh from the Indian operations. The designing charges received during the year were rupees 20 lakh. Compute the net profit for me. Viraj, I already explained the meaning of P. P means the fixed place of business or the branch or an office. Mansha, interest paid by PE to HO is not always deductible. It is only for the banking companies. If you see section 915 explanation, it was only for the banking companies and not always. No, Kaushiki, try yourself. Purushottam, how did you get 31.5? Okay, let's do one thing. Let's remove this net profit which is given. So then I think that will make it more easier. Now it should be very easy. Yes. Okay, let me solve it for you. See, it's very simple question. It has started the office. Now this office is providing the services. So this is where that ABC INC has a PE in India, and this services of designing which are provided. Now designing services will be fees for technical services, and this is effectively connected to the PE because PE is performing the operation. So therefore section 44DA will be applicable. Now for 44DA, what will you do? What is the amount I have received? Receipt is 20 lakh less expense wholly and exclusively incurred by P. So in this case, what are the expense which is wholly and exclusively incurred by P? Office expense, which is 2 lakh. Right? Now, this is incurred by the head office, 1 lakh each, which is there. It has 10 employees, and this 1 lakh which is there is incurred by the head office. So what did I tell you over here? The expense amount paid by PE to HO will not be allowed as deduction other than reimbursement of actual expense. Now these expenses are also of PE because these employees were incurred for the PE. So less expense reimbursed to HO, 10 lakh. Fine. Now this particular which is there, software, designing software amounting to 2 lakh. Now this is to be used by other offices also. So means this is not wholly and exclusively for PE. So this will not be allowed as deduction. ABC has also charged some common admin expense that will also be not allowed as deduction, which is wholly and exclusively only for P only, that is allowed as deduction. So in this particular case, my net profit will be 8 lakh on this, tax at the rate of 40%. Clear? Is it clear, Purushottam? You will not get 50 and not wholly and exclusively for the P. Is it fine? Okay. Last one under the presumptive part, which is not presumptive taxation, but this is the deduction of head office expenses under section 44C. So if you see, the head office expenditure is not allowed as the deduction. The head office expenditure is not allowed as the deduction. So for that purpose, we have a specific of the head office expenditure, which is provided under section 44C. So section 44C provides for the head office expenditure. What does it provide? It provides that what will be the amount which will be allowed as the head office expenditure. Are we clear? So 44C is something you will consider for the purpose of computing the head office expense. Fine. What does section 44C provides? Let's try and understand. So in case of a non-resident, the head office expenditure which is allowed is restricted to, this is the provision for restriction on the head office expense, which is least of the following will be considered for the restriction. A, 5% of adjusted total income, or in case of loss, 5% of average adjusted total income, or B, the amount of head office expense attributable to, the amount of head office expense attributable to business or profession in India. Now, what is adjusted total income? Adjusted total income means total income without considering unabsorbed depreciation, expenditure on the family planning, expenditure on the family planning, which is unabsorbed, brought forward business loss, speculation loss brought forward, the loss under the head capital gain, the loss from the specified business, and deduction under chapter 6A. Okay. Sorry, this is not the specified business loss. Instead of specified business loss, sorry. Here, loss from activity of owning and maintaining income, total income for the 3 assessment years immediately preceding the relevant assessment year. Okay. So this is you have to take for 3 assessment year. Average means for 3 years. And what do we mean by the head office expense? Head office expense means the expenses like rent, rates, taxes, repairs, salaries, insurance of any premises outside India, or salaries, then paid to salaries paid to the employee, salaries paid to the employee for managing the affairs any office outside India, for affairs outside India. Right? So salary, wages, pension, bonus, commission, all these, whether paid or allowed to any employee or any other person in or managing the affairs of any office outside India. So these are the head office expenses, and this will be allowed to the extent of 5% of adjusted total income or the actual head office expense, which is there, least of that. Are we clear? Any questions, any doubts? Any questions, any doubt? Yes. Fine. Any doubt? Yes or no? Are we clear up till this? Designing structure purchased. Software. Kaushik, it was not structure. Purushottam, P is not reimbursing. Whenever P is reimbursing, not all the expenditure are to be allowed. It is only the actual expenditure which is to be allowed. Now, this and one which is wholly and exclusively for the P. Here, this is not wholly and exclusively for the P, hence we are not allowing it. Yes, Mansha, adjusted total income in ATG is different. That is defined in ATG for the purpose of ATG. For 44C, here it is different definition. Clear, Mansha? Okay. Fine. So shall we move ahead then, in case there are no questions? Yes or no? Fine. Fast, tell me. So we have understood the presumptive section. Then we have done the 44DA, and now we have done the 44C, which is for the head office expenditure. Fine. Now let's move further. Now this was the PGBP part. We also have the capital gain part, which is there. So we have done the PGBP aspect, and now we are moving towards the capital gain. Now under capital gain also there is the taxation for non-resident. Capital gain taxation, which is specifically for non-resident, which is what we are going to deal with as of now. Now, with respect to the capital gain taxation, the first provision what we are going to deal is the first proviso to section 48. So, if you remember, while we were dealing with section 48, we had done the first proviso to section 48. We had just briefly discussed at that point in time. Can anybody tell me what is this first proviso to section 48? Yes. Can anyone tell me? First proviso to section 48. What is it? Very fast. Yes, fast. What is first proviso to section 48? Fast. I'm waiting for your answers. Yes, Purushottam, it is foreign exchange rate. No, Kaushiki, not non-resident Indians. No, foreign exchange rates. But what is exactly that? What was it exactly? Fast, tell me very quickly. What is first proviso to section 48? Nobody remembers? Yes, very quickly. Very good question, Purushottam, whether 44C will apply to section 44DA. So see, the 44DA which is there, that is in respect of the royalties fees for technical services, right? There it is clearly said that in respect of any amounts which are paid by the P to the HO, no deduction shall be allowed. So therefore, for 44DA, you will not allow any deduction for the amount paid by the P to the HO. So therefore, there's a clear restriction which is there. So therefore, 44C is a separate provision, 44DA is a separate provision. Although, if you see 44C, 44C is a notwithstanding clause. It overrides section 28 to 43A. It doesn't override 44DA. But 44DA also is not a notwithstanding clause, but there's a clear provision of not allowing the head office expense. Clear? So it will not apply. First proviso to 48 is applicable for non-resident Indians. Only 48 becomes applicable when a non-resident buys an asset which is then converted into INR. So, okay, let me explain what is first proviso to section 48. First proviso to section 48 is a foreign exchange benefit, foreign exchange fluctuation benefit. Now, how do we calculate the first, how do we compute the first proviso to section 48? Let's try and understand. So, in case of a non-resident who invests foreign exchange to acquire the capital assets, this is only for them. So, if a non-resident acquires the asset in India using the foreign exchange, using the foreign exchange, if they acquire the asset, then in that particular case, they can get the benefit of the first proviso to section 48. Now, this is applicable to whom? Let's try and understand. And this is applicable only to certain category of the assets. What is that? That is also we are going to look at. But this is the foreign exchange benefit which is given, or the fluctuation benefit which is basically given. Are we understanding that? Okay. So first proviso to section 48, this is foreign exchange fluctuation benefit which is given. Is it clear? Now what does it provide? The first proviso to section 48 provides that in case of a non-resident, in case of an assessee who is a non-resident, this is not only provided to cautiously non-resident Indian, but this is to every non-resident eligible assessee is non-resident and not non-resident Indian. The capital gains from the capital asset. Now, what is the eligible capital asset? The eligible capital asset being shares of an Indian company, debentures of Indian company, shares of the Indian company and debentures of the Indian company. But remember one thing very clearly. If you read section 112A, which is for the LTCG on the listed equity shares. LTCG on listed equity shares, you will not be allowed on listed equity shares. First proviso is not applicable. First proviso will not be applicable. Similarly, in case of the unlisted securities or shares, unlisted securities or shares of a private limited company, under 112, you are offered a 10% tax rate. So there also, first proviso to 48 is not allowed. When you pay the tax under 112, you are not allowed the first proviso benefit. So even for unlisted shares, first proviso is not applicable. So for the listed as well as unlisted shares, the first proviso is not applicable. So then for which shares this is applicable? This will be applicable in a case where you're not falling under 112A. Where let's say, for example, you have purchased the shares not through stock market. And these are the listed shares. Then 112A is not applicable. You're coming into 112. That time you will take the benefit of first proviso to section 48. Fine. Are we clear? Because on unlisted also this is not applicable very clearly. Fine. Then what does it provide is the first proviso to section 48. The first proviso to section 48, it provides the benefit of the exchange rate fluctuation where the non-resident acquires the capital asset, which is the shares of the Indian company or the debentures of the Indian company. Shares or debentures of the Indian company. Now, how the benefit is to be given? You have to Consider the cost of acquisition. The expenditure incurred which is on transfer and the full value of consideration are to be converted first into the foreign currency using which you acquired the shares or debentures. And then you compute the capital gains into the foreign currency. Once you have computed the capital gain in foreign currency, then you reconvert the capital gain into Indian currency. So cost of acquisition, full value of consideration and expense on transfer converted to the foreign currency. This is your step 1. Step 2 is compute the capital gain. And step 3 is convert capital gain into INR. Convert the capital gain into the INR. Is it clear? So first you will convert it into foreign currency and then you will convert it into the capital gain amount. You will reconvert into the Indian currency. Here non-resident means even a foreign company as well. So this is applicable to both non-resident as well as the foreign company. Are we clear? Is it fine? First proviso to section 48, it is applicable to shares or debentures of the foreign company. First proviso is mandatory to opt. It's not that the non-resident will say, okay, I'll not go for the first proviso, I'll go for the indexation and the second proviso. No, that is not going to be there. Also, this proviso is applicable for both short-term and long-term capital gains. So, this is also applicable where you are going under 115A. Where you are going, 111A. So where you go under 111A, then in that particular case, if it is listed shares and you pay the short-term capital gain tax under 111A, so this may be applicable there as well. Are we getting it? So this is applicable to both the long-term as well as the short-term capital gain. Are we clear? Any questions so far? Are we clear? So if the total income of the assessee includes the capital gain on transfer of the equity share, then tax is under the 111A if it is a short-term capital gain. And if it is a long-term capital gain, then tax is under 112A. Are we clear? Now the shares and debentures of the Indian companies which are listed, not the debentures, the shares of the Indian company which are listed, that will be under 112A. But 112A restrict the claim of the first proviso to section 48. 112A will restrict the claim of the first proviso to section 48. If it is unlisted, then also 112 will restrict it, the claim of the first proviso to section 48. But 111A is not restricting it. Even if it's unlisted, then also you can claim even for the long term or short term capital gain both. Fine. Now, what are the conversion rates to be used? The conversion rates is as per the rules which is provided under 115A. The conversion rate you have to take as per the rule 115A. Now, for the sale consideration, you will take average of TTBR and TTSR, telegraphic transfer buying rate and selling rate, as on date of transfer. For the, or instead of sale consideration, write the full value of consideration. For the expense on transfer, again you have to take the average of TTBR and TTSR as on date of transfer. For the cost of acquisition, you need to take average of TTBR and TTSR as on date of acquisition. And for the capital gain, you will take TTBR as on date of transfer. Fine? Clear till now? Kaushiki, this is a benefit because you have purchased in foreign currency. Now, let's say, for example, if the rupee has increased, then you are not getting in that particular case the benefit of the exchange rate difference. So that is allowed to you. Are we clear? Okay. So this is a benefit of the foreign currency. You will see, I'll give you an example. Quickly write down the example and then we'll take a break. During the break, you'll solve the question. A non-resident purchases shares of RIL on 1/1/2013. Instead of RIL, let's write down purchases the shares of, let's say, ABC Limited. Okay. On 1/1/2013 by remitting US dollar. By remitting US dollar. Following data is given. Cost of acquisition rupees 5,85,000. Rupees 5,85,000. Then date of sale 1/1/2023. Sale price rupees 9 lakh. Sale price rupees 9 lakh. Date of transfer 28/12, sorry, 28/12/2018. Expense on transfer rupees 6,000. ABC Limited is a listed company, but shares are purchased through an off-market transaction. This transaction does not fall under exception notified by CBD. Okay. So this is not clearly and following under the exception also. Then exchange rates. $1 is equal to rupees, which is given. So this is for the TTBR. This is for the TTSR. Dates are 1/1/2013, 38/40. Then 28/12/2018, 42/44. 1/1/2019, or 1/1/2023, sorry. $39.41. 24th April 2023, 40.42. 31st December 2023, 41.43. Yes, calculate the capital gain quickly for me. And I'm taking a break of 10 minutes. You can take a break of 5-7 minutes and then we can get back. What is TTBR? Telegraphic transfer buying rate, Kaushiki. Okay. Yes, students. What is the answer you are getting? Purushottam, if the currency is depreciated, then you will not get the benefit. Is it still first proviso will apply if the gain realized in India reinvested? Okay, we'll talk about the reinvestment after this. So I'll answer you the question after we are done with solving this. Okay, so let's solve it together. In this particular case, first I'll convert the sales price. What is my sale price? It is 9 lakh, right? In rupees, this is 9 lakh. What is the exchange rate which I will take? As on the date of transfer. So which is on 1/1/23. So 39 plus 41 divided by 2, which is give me 40. So 9 lakh divided by 40 in foreign currency, I will get 22,500. This is in dollars. Less expense on transfer. How much is expense on transfer? 6,600. Again, this I'll take on the same day, which is 39 plus 41 divided by 2 is equal to 40. This will give me 165. Okay. Then the cost of acquisition. What is my cost of acquisition? 5,85,000. This I'll take on the date of purchase, which is 1/1/2013, which is 38 plus 40 divided by 2, which will give me 39. This will give 15,000. So what is my capital gain coming to? My capital gain will come to 7,335 US dollars. I'll reconvert it. So LTCG, this is LTCG, right? More than 12 months listed equity shares. So this is LTCG. 7,335 into, I'll take the TTBR as on the date of transfer, which is 39. So this comes to 2,86,065. Are you getting this answer? Yes, 2,86,065. Correct, Purushottam. Kaushiki, how you are getting 2,49,000? Viraj, date of transfer is 2023. So we have taken 1/1/23. Date of transfer is, okay, sorry, this is date of purchase, not transfer. Sorry. This is my date of purchase. I'll correct it here. Yes, Kaushiki, I have corrected it. Purushottam, yes, got it. Is it clear? Yes or no? Yes or no? Is it very clear? Fine. Okay. Now I'm adding a twist over here. I'm just adding one more point over here. Let's say on 24th April 2023, rupees 6,15,000 was invested in shares of ICICI Bank out of sale proceeds of rupees 9 lakh, which were sold on 31st December 2023 for rupees 10 lakh 50,000. For rupees 10 lakh 50,000. What you will do in this case? Date of purchase is 1/1/2013. So date of sale is 1/1/2023 and date of expenditure on transfer is, so date of purchase is 1/1/2013. The purchase date is 1/1/2013. This we can, one second, remove altogether because this is, I think I have wrongly mentioned it. So you can remove it, even here. This 2018 is no relevance. Geeta, I have corrected it. This 18 was my mistake, so I have removed it. Purchase is 1/1/2013 and then sale is 23. Fine. Is it clear now? Yes, Purushottam, you are getting correctly. Okay. So this is the reinvestment. Here we have done the reinvestment from the proceeds of the shares of ABC. We have reinvested in ICICI Bank. Now this is the short-term capital gain. As I told you, first proviso is applicable to both short-term as well as long-term capital gain. Correct? Now, this is the case of reinvestment. Now, if it is a case of reinvestment of the share, whether first proviso to 48 will also apply to the reinvestment, because here you are investing in INR only. You are not investing in foreign currency. Remember here, you had first invested foreign currency, then later on you have invested in INR only in ICICI. You have not invested foreign currency. So the question which arises is that whether here this will also apply first proviso to section 48, will it be also applicable in a case where it is a question of reinvestment? So Kaushiki, in that particular case, first proviso to section 48 will also be applicable in the case of reinvestment. So the computation of capital gain shall be applicable in respect of capital gains from every reinvestment. Are we clear? So this will be applicable on every reinvestment. So what is the answer then? In this particular case, your sale consideration is 10 lakh 50,000 in INR. Foreign exchange rate will be what? This is on 31st December 2023. So 41 plus 43 divided by 2. So US dollar will be 25,000. Right? Less cost of acquisition. This is 6,15,000. What is the exchange rate you will take? Will you take the exchange rate as on the original update or on the date of reinvestment? We'll take on the date of reinvestment, which is 24/4/23. So 40 plus 42 divided by 2 equal to 41. This will give me 15,000. So 10,000 is my short-term capital gain because this is less than 12 months. Fine. Is it clear? Yes or no? Yes or no? Is it clear? Yes. Clear? Is it clear? If it would have been a listed company where the shares are sold through a stock exchange, in case of long-term capital gain, we would have not applied then the first proviso to 48. Fine. Any doubt, any question? Any doubt, any question? Clear or not? Okay. Yes. Can you explain, Anarga, how we choose the foreign exchange rate? We have written over here, Anarga, isn't it? Average of TTBR and TTSR for the full value of consideration as on the date of transfer. For the expenditure, TTBR and TTSR as on the date of transfer. For the cost of acquisition, TTBR and TTSR as on the date of acquisition. And then you reconvert the capital gain by applying TTBR as on the date of transfer. So here I have not converted the capital gain. Here I will have to convert it. So 10,000 into 41, which is the TTBR as on the date of transfer. So rupees 4,10,000 is my capital gain. Clear? Viraj, the expense which is there on the transfer is 6,600. This is 6,600. Fine. This is 6,600. The expenditure is 6,600. Kaushiki, this is the extended benefit that you have brought the foreign currency, and therefore they are extending the benefit even for the reinvestment because you are reinvesting your foreign currency. Clear, Kaushiki? I'll explain the sum once again. See, this was the in the first case, we had purchased the shares of the listed company which were not through the stock exchange. So therefore, therefore we gave the benefit of first proviso to 48. Sale price was 9 lakh. Then you have taken TTBR and TTSR as on the date of transfer, 39 plus 41 as on 1/1/23. You have taken expenditure on transfer 6,600 again on the same date, and cost of acquisition is 5,85,000, which is as on the date of purchase, which is 1/1/2013. 38 plus 40 divided by 2. And then you compute the capital gain. You have taken the capital gain and again converted it as on the date of transfer, the TTBR rate, which is 39. Now this amount was reinvested, the sale amount. So on that also we are allowing the foreign exchange fluctuation. Clear? Now, let's say in this particular case, let's say in this particular case, instead of the non-resident, the taxpayer, instead of the taxpayer as non-resident, let's say the taxpayer is non-resident Indian. Let's say the taxpayer is non-resident Indian. Then for them, chapter 12A is applicable. Then for them, chapter 12A is applicable. So in case of an NRI, the provision of chapter 12A is applicable. Now what is chapter 12A? We are going to talk about chapter 12A. Listen to this very carefully. Chapter 12A is specifically for the non-resident Indian. Chapter 12A is specifically for the non-resident Indian. These provisions provide for the lower tax rate which is available to the non-resident Indian under section 115E. Tax rate under section 115E. Now, what does it provide? It provides that in case of a specified asset, what is a specified asset? The specified asset means, the specified asset in this particular case means the shares of the Indian company, debentures issued of Indian company, which is not a private company, so shares of the Indian company, debentures issued of the Indian company, which is not a private company, deposits of Indian Public Limited Company, deposits of Indian Public Limited Company, central government securities, National Savings Certificate, NSC, National Savings Certificate, NSC. So in this particular case, the specified assets which are only given over here are basically covered. Now, what does it provide? That if the non-resident Indian, who is a non-resident Indian? Non-resident Indian means the citizen of India, which is an Indian citizen or person of Indian origin. Indian citizen or person of Indian origin. If he buys the specified asset, which is the shares in Indian company or debentures of the Indian company, deposits with Indian company, security of central government, then in that particular case, if he uses the foreign exchange to buy this asset, if he uses the foreign exchange to buy the asset, then he can avail these special provisions under Chapter 12A. Non-resident Indian, only non-resident Indian. First proviso to 48 is applicable to all non-residents, including foreign company. This is only applicable to non-resident Indian. Non-resident Indian means the Indian citizen or a PIO. Who is a PIO? PIO means a person whose either of his parents or grandparents were born in undivided India. whose either parents or grandparents were born in undivided India. Are we clear? So in that particular case, Chapter 12A is applicable. Now, what does Chapter 12A tax rate under 115E provides? In case of investment income, in case of the investment income, which is other than the dividend, in case of the investment income which is there, and the long-term capital gain, in case of the investment income and the long-term capital gain on assets other than the specified assets, on other than specified assets, tax rate is 20%. In case of long-term capital gain on specified assets, it is 10%. So specified asset is this, which is purchased in foreign currency. Which is purchased in foreign currency. Are we clear? So investment income and LTCG on other than specified asset is 20%. LTCG on specified asset is 10%. Are we clear? So this is the benefit which is given only to the non-resident Indian. This is the benefit which is given only to the non-resident Indian. Now here, understand one thing, that the tax will be on the gross basis, meaning you will not be allowed any deduction. No deduction under Chapter 6A. This is on gross basis. No deduction under Chapter 6A which will be allowed. Indexation benefit will also not be available. No indexation benefit, meaning second proviso is not applicable. Are we clear? But you can avail the first proviso to Section 48. So first proviso to Section 48 is available. First proviso to Section 48 is available. Are we clear? Are we clear? So in earlier case, you can claim the 10% rate on long-term capital gain and also claim the first proviso to Section 48 if the taxpayer was a non-resident Indian. Clear? Are we clear? Next important point. You remember 54F? 54F was that you sell any asset and invest in immovable property. There is a similar exemption from the long-term capital gain which is available under Chapter 12A, which is under Section 115F exemption. Exemption under Section 115F. Now, what is this exemption? Understand this very carefully. This is applicable only on long-term capital gain. Long-term capital gain on sale of specified asset. Long-term capital gain on sale of specified asset. And if you reinvest, the eligible asset is if you reinvest in the shares. So under 115F, there is a similar exemption which is being available, which is under 54F, right? What is that exemption? That you reinvest that particular exemption, that you reinvest that particular amount in any specified asset. So eligible asset is again specified asset. What is the time limit for reinvestment? This is exemption on reinvestment. Time limit is 6 months from the date of transfer. 6 months from the date of transfer, if you reinvest in the specified asset, then in that particular case, you will be allowed the exemption. And what is the exemption? Same like 54F, which is long-term capital gain into amount invested divided by net sale consideration. There is a lock-in again here, just like we had it under 54F, which is 3 years from the date of acquisition of new asset. So you do not have to transfer the new asset within 3 years from the date of acquisition in order to claim the exemption under 115F. If you transfer the new asset, then there will be withdrawal of exemption. What is the withdrawal of exemption? The exemption granted earlier shall be taxed as long-term capital gain of the previous year in which new asset is transferred or converted into money, or you can just write new asset is transferred. Are we clear? So in that particular case, your exemption will be withdrawn. Are you getting this? Any doubt till now? Clear? Okay. So in this particular case, you will be given this exemption. Now, look at this previous problem which we solved, where I told you, let's assume in this case, the assessee was a non-resident Indian. Then, will you give the exemption under 115F? And what will be the exemption amount? You have to tell me. Think about it and tell me. Yes, Kaushiki, you have to compute the exemption. Kaushiki, yes, it will be withdrawn. because the lock-in period is not visible. Okay, the lock-in period is not visible. So, sorry, Viraj, the screen is not visible. Okay. The lock-in period is not fulfilled, so the exemption will be withdrawn. But what will be the exemption which will be granted at the first place? Compute that. Purushottam, if the shares are purchased before 1/4/2001, you will take the exchange rates as on 1/4/2001 in case it is not available prior to that, because you are taking the value as on that day. Yes, Purushottam, no, the exemption is not correct. There is some minor mistake that you have done. Let me calculate it for you. So exemption under section 115F in the previous question, it was 2,86,065 was your capital gain, right? You had made investment of 6,15,000, right? So that is your reinvestment amount. What was the sale consideration? It was 9 lakh, out of which you will reduce the expenses on transfer of 6,600, because you need to take the net sale consideration. So this will give you 1,96,921. And since lock-in period of 3 years is not fulfilled, the lock-in period of 3 years is not fulfilled, the exemption granted will be revoked. It shall be taxable as income of previous year 23-24, because the exemption you are claiming in 22-23 previous year, and you are transferring the asset in 23-24, so it will be income of 23-24. Clear? Purushottam, note how 2,02,388. This will be the amount which will be taxed. What was the exemption given to you? Clear? Geeta, 196,921. Kaushiki, what is 6,15,000 into 42? Is everybody clear with this answer? Yes? Okay. Now, last few points to this chapter 12A. This is something under chapter 12A. You can exercise the option of not opting in for the chapter 12A. It's not mandatory. So, a non-resident Indian may choose to opt out by furnishing return of income under section 139 and declaring that chapter 12A shall not apply to him. Okay? A non-resident may choose to opt out of this particular provision in case he wants to. But in case he chooses to remain under this provision, then ROI is not required to be filed if income consists of only LTCG and investment income and TDS is deducted on such income. Then ROI is not required to be filed. Even when he becomes the resident from a non-resident Indian, even when he becomes the resident, then he may furnish to the AO a declaration along with his return of income under 139 that these provisions, the chapter 12A, shall continue to apply to him in relation to the investment income derived from the foreign exchange asset other than the shares of Indian company. So even if he becomes the resident, he may write to the AO that he still holds that foreign exchange asset, and with respect to that asset other than the shares of the Indian company, the chapter 12A should continue to apply to him. Are we clear? Until the shares are until the specified asset is transferred. Okay. So even after he becomes the resident, he can request to the AO that this provision may continue to apply to him. Are we clear? Yes or no? Any doubt? Any question? Yes or no? Okay. So when a person becomes the resident, he may furnish a declaration to the AO by filing the return of income that these provisions shall continue to apply to him from the on the investment income from the foreign exchange assets, and in that particular case the provisions will then continue to apply until the foreign exchange asset is sold. Clear? Okay. Yes or no? Yes. Any doubt, any question? Is this clear before we move on to further? Yes, Geeta. It's all right, Purushottam. Fine. Okay, let's move further then. Now we are moving to few important sections which are very small, but this is something which is, the tax rates again for certain specified assessees who are non-resident. Okay. First is section 115AB. These are special tax rates. Section 115AB. This is tax on income from. These could, come as MCQ, not more than that. Units purchased in foreign currency or capital gain from transfer in case of offshore fund. This is applicable to the offshore fund. So where the income includes the income received on the units purchased in foreign currency, or it is a case of long-term capital gains, then in both these situations, the tax will be 10%. Tax will be 10%. Long-term capital gain on transfer of mutual fund units. Then it is 10%. Here, indexation will not be available. So, no indexation, and in this particular case, Chapter 6A also not available. No Chapter 6A deduction. Fine. So this is a small section which I just told you. Fine. Next one is section 115AC on GDR and ADR on the global depository receipt, or you can just try global depository receipt in case you are not confused. Okay. Global depository receipt. Now, what is global depository receipt? First, let's understand the concept. Let's spend 2 minutes to understand the concept of what is the global depository receipt. And then we, move on further to understand what exactly is the taxability of these kind of income. Now, the global depository receipts are basically for listing the shares of the Indian company on the foreign stock exchange. So it is not possible to directly list the shares of the Indian company on the foreign stock exchange. So what the Indian companies do is they issue their GDRs, global depository receipt. So let's say, for example, let's say this is Reliance Industry Limited, right? This is a listed company. What it will do is it will issue the shares to the bank. It will issue the shares to the bank who will act as a depository. Now, this bank will then issue the GDRs, depository receipt, to the foreign bank. Now, this foreign bank will then, this particular foreign bank can then issue the depository receipts to the investor or the foreign investor who would like to purchase the GDRs, because these GDRs which are there are listed, let's say, on New York Stock Exchange. So these depositories are listed on, these depository receipts are listed on the New York Stock Exchange. And this can be then traded. So listed GDR. Are we clear? So the shares are not listed, but the stock exchange, on the New York Stock Exchange, the GDRs of the underlying share is listed. Are we clear? So if an Indian company intends to list its share on the foreign stock exchange, it can do through the GDR or through the ADR. And these ADR or GDR derive the value from the underlying shares. So first, Reliance Industry will have its shares listed on the Indian Stock Exchange, right? If it intends to list on the New York Stock Exchange, it will issue its shares to the Indian Depository Bank. Indian Depository Bank will then pledge or issue those shares to the Foreign Depository Bank, and the Foreign Depository Bank can issue those shares, can issue those GDRs against the underlying shares. Fine. The foreign investor can also buy it through the New York Stock Exchange. Clear? Is it very much clear? What is GDR, ADR? Fine. Now, where Viraj, you're asking to repeat the last sentence, where exactly, if you can point out. Okay. Now, how does the taxability work? Let's try and understand. So, the taxation of GDR is under 115 AC. GDR purchased in foreign currency. GDR purchased in the foreign currency. If the GDRs are purchased in the foreign currency, then it is under 115 AC. Are we clear? What is the tax rate? If it is purchased by the non-resident, then under section 115 AC, the capital gain which is there, if it is a long-term capital gain, then in that particular case, there are two things to it. Now, the income by way of long-term capital gain from the transfer of the GDRs, income from the transfer of the GDRs, if it is a long-term capital gain, and if it is transferred to the resident, if it is transferred to the resident, then it is 10%. Then it is 10%. If it is transferred to the non-resident, then there is exemption under 47(7)(a). So, in case the GDR is purchased by a non-resident, the taxability is under 115 AC. If it is a capital gain, which is a long-term capital gain, then in that case, if it is transferred to a resident, then it is 10% under section 115 AC. If it is transferred to a non-resident, that is not regarded as transfer under section 47(7)(a). Are we clear? Sorry, here we should not write 115 AC because I am writing it over here. If it is a short-term capital gain, then if it is transferred to a resident or a non-resident, taxable at normal rates. It is taxable at the normal rates. Are we clear? So if it is a long-term gain transferred to a resident, 10% under 115 AC. If it's a short-term, it is taxable at normal rates. If it is transferred to a non-resident, it's a long-term capital gain, there is exemption under 47(7). Clear? If it is purchased by a employee of specified Indian company. What is the meaning of specified Indian company? IT company, entertainment company, pharma company, or a biotech company. Then it is taxable under 115 ACA. Then it is taxable under 115 ACA and the tax rate is again the same. Tax rate is again the same for the capital gain. Is it fine? So tax rate is same under 115 ACA. Clear? Now again here, this is on the gross basis. Taxability on gross basis, meaning no deduction under chapter 6A. Deduction under Chapter 6A, not applicable. Are we clear? Further, you will not get benefit of, no benefit of indexation as well as first proviso to section 48. So you will not get any indexation benefit or first proviso to section 48. Clear? Are we clear? Further, let's say for example, if it is, this was capital gain, right? Let's say this is, let me make it very simple chart for you. One second. GDR purchased in foreign exchange if it is capital gain. And now I'm talking about the dividend or interest. If it is income by way of interest on the bonds of Indian company or income by way of dividends, then that will also be taxed at 10%. Dividend or interest will also be taxed at 10%, again under 115 AC. Clear? Any questions, any doubts so far? Any doubt? So dividend or interest will also be taxed at the rate of 10% under 115 AC. Are we clear? Yes or no? Yes or no? Quickly reply to me in chat box. Yes? Okay. Shall we proceed further then? Now understand one thing very clearly. Here what we did is for the capital gain and dividend or interest. But what will be the period of holding? What is the period of holding which you will consider? Tell me, what is the period of holding which you will consider? Yes, what is the period of holding? Yes, Viraj, very good. Purushottam, GDRs are and shares are not held by same person. Shares are with the underlying company. GDRs are held by the foreign investor. Yes, Viraj, it's 36 months. Yes, Purushottam, very good. 36. Yes, very good. So the period of holding will be 36 months and not 24 months because these are not shares. Okay. Neither these are listed or unlisted shares. So this is period of holding is 36 months. Now let's move further. Now let's say this is a non-resident, right? Now this non-resident has two options. Either he can redeem the GDR. Either he can redeem the GDR. Now, if he redeems the GDR, he will receive the shares. He will receive the shares. Now, if that be the case, then in that particular case, the full value of consideration will be the value of shares. Full value of consideration will be value of shares. Cost will be the cost of GDR. Period of holding will be 36 months. And tax rate will be normal rates. Tax rate will be normal rates because he is redeeming and not transferring these shares. Right? He is redeeming the GDR and not transferring. So the tax rate can be this also. If he has purchased it in foreign currency, the GDR, then the tax rate will be as per 115 AC if he transfers to a resident. Here he is redeeming. If he is redeeming with a resident depository bank, then in that case 10%. If he is redeeming with the non-resident depository bank is there, whatever the arrangement is there, mostly it will be non-resident, then it will be exempt. Fine? Clear? Or you can write it here, rates under (115) AC. If he is transferring the GDR with the non-resident bank. Clear? Or otherwise, it will be normal rates. Because this is redemption and not a transfer. This is redemption and not a transfer. This is just the redemption of GDR. This is not a transfer to another non-resident. Clear? In case of, if he redeems the GDR, this was the first thing where he has sold the GDR. Right? In the first case, he has sold the GDR. Now, in the second case, he is redeeming the GDR. Now, if he is redeeming the GDR, he will get the shares. Now, if he sells the share, if there is subsequent sale of shares. Now, if there is subsequent sale of shares, the shares which he have received, then the full value of consideration will be the selling price. Cost of acquisition will be the full value of consideration of the GDR. The cost will be the FVC of GDR, this wise. Right? Because here you have already taxed it, so this will be considered as cost of acquisition. Clear? The period of holding will be here 12 months because you are transferring now shares. And the tax rate will be 111A or 112A. Fine. This is one. So if the GDR, I'm just quickly summarizing it for you. If it is sold, and if it is transferred to a non-resident, then exempt under section 47(7)(a). If it is transferred to a resident, then 10% under section 115AC. Fine. If it is redeemed, then in that particular case, sale price will be the value of shares. Cost of acquisition will be the cost of GDR. Period of holding will be 36 months. And tax rate will be normal rates. Fine. Are we clear? Yes or no? Is it clear? Perfect. Shall we move further? Yes or no? Purushottam, redemption is a transfer. It is falling within the definition of transfer, but it is not falling under 115AC because technically it is not transferred to a non-resident. That's what I said. Redemption is a transfer. That's why it is coming into the capital gain. That's very clear. But this is not a transfer to a non-resident or even to a resident. Because this is not something which is coming through a sale. Are we getting that? So 115AC, if you look at, it is coming from the perspective of that the income by way of long-term capital gain arising from the global depository receipts, which is the transfer which happens on the stock exchange. Okay. So GDR, if it is issued and against the share, and that doesn't cover the redemption specifically. Are we clear? That's why I wrote there that 115AC can come into picture if one can argue that this is a transfer to the Indian bank based on how the GDRs are issued. It is a redemption with the Indian bank, but that is not going to happen. It is a redemption with the foreign bank itself because the foreign bank has those GDRs. It will then request to the Indian bank and then Indian bank will issue the shares. Clear? Okay. Yes or no? Although one can argue that in this particular case, Purushottam, that here 10% tax rate should be applicable and not the normal rate because this is also a kind of income from GDR only. So therefore, here the 10% tax rate should apply. So that view one can take it. What if the business of NR is purchase of GDR? Yes, it is covered, but then it will not be long-term capital gain. It will then be the business income, Purushottam. Only if it is considered as long-term capital gain, only in that case you will consider. So you can maybe write it over here. One view you can take it. Here you can write one view, 115AC, 10% should apply as income from GDR. And second view is that this is not a transfer to a non-resident or resident and it's a redemption, so normal rate should be applied. Okay? So that's why I wrote that there are two views to it. Fine. Last one, last section, which is under the special tax rate, which is 115AD. Now again, this is a very important section. Section 115AD. Now what is section 115AD? Section 115AD, which is there, this is for the foreign institutional investor. This is for the foreign institutional investor that this section has been introduced. Now, what does this section particularly provide? This provides a special tax rate for the foreign institutional investors. So let's write down very quickly. Okay. Sorry. Yes. Income from first is income from securities other than units of mutual fund and interest under 194 LD. LD was on the bonds, right? We did that day itself, which is in this particular case 20%. 20%. Okay. Interest under 194 LD. Interest under section 194 LD. What was interest under 194 LD? We did that day itself under 115A while we were doing it. Remember? While we were doing tax rate. This one. Interest on rupee denominated bond or government securities to FPI. It is 5%. Okay. One second, I think file is not responding. Are you able to see anything on the screen? Yes. Rupee denominated bond or government securities. Shit, what is this? One second, there's some issue. Yeah. This is 5%. Fine. Next is the income by way of short-term capital gains. Short-term capital gains, listed shares, that is under 111A, 15%. Others, it is 30%. Income by way of long-term capital gain, again if it is listed, then 112A, 10% over rupees 1 lakh. Others, again 10%. Others 10%. Fine. So this is your section 115 AD. Now for the surcharge on 115 AD, the highest surcharge will be 15%. The highest surcharge will be 15% and it will not go to 25% and 37%. Right? So if you know the surcharge which is there on the excluding the short-term capital gain or the dividend, long-term capital gain, the highest surcharge on STCG, LTCG and dividend is 15% even if the income exceeds 2 crores. Clear? So the surcharge on this income including dividend, long-term capital gain under 112 or short-term capital gain under 111A exceeding rupees 2 crore will be 15%. Fine. This is again on gross basis. That is no chapter 6A deduction plus no first and second proviso. No first and second proviso to section 48 is available. Are we clear? Yes or no? Clear? Yes or no? Is there any doubt, any question? Fine. Now the last section in this respect is 115 BBA. 115 BBA is for the non-resident sportsman or sports association. 115 BBA section, non-resident sportsman and sports association. So what is the income which is covered here? What is the income under non-resident sports person and sports association which is going to be covered? Let's quickly write down. So for the sportsmen, income received by way of participation in any game in India. Right? Other than a game, the winnings which are taxable under 115BB, which is crossword puzzle, race horses, all of those games. So other than race horses, crossword puzzle, right? Or card games or gambling. Advertisement income. Contribution of articles to any game or sports journal. To any game or sports journal or newspaper in India. So any income from participation in any game, from any advertisement, or from contribution of any articles to any game or sports in India and any newspaper. Now, who is a sportsman? A sportsman is any person who is not a citizen of India and is a non-resident. So you can write down non-resident and non-Indian citizen. Non-resident and non-Indian citizen. Sportsman. Okay. Second is entertainer. Any entertainer who is again a non-resident and non-citizen of India, having the income from performance in India. Income from the performance in India. Third is a non-resident sports association or a sports institution. Having the income from any game or sports played in India. Any game other than the winnings, income from other than winnings or sports played in India. In this particular case, the tax rate will be 20% on gross basis. 20% on gross basis. Further, there will be TDS also. The TDS will be under section. The TDS in this case will be under section 194E. At the rate of 20%. Further, in this particular case, no return of income is to be filed. No return of income is required. No ROI is required if total income includes the above income. Total income includes only the above income and TDS is deducted on same. And TDS is deducted on such income. Are we clear? Any questions, any doubt? Now there are 2-3 case laws which I'll just quickly discuss with you. Number one is whether the non-resident referees and umpires in the games fall within the meaning of sports person so that they could fall under 115 BBA. So in that particular case, Calcutta High Court in Incom said that the person should be a non-resident sports person. Umpires and match referees are professionals or technical person who just render some professional or technical service. They are not sports person. So umpires and match referees are those the payment made to them will accrue or arise in India because these are technical services, but that is not a payment to a sports person. Here 194E will not apply, 195 will apply. So you can write down umpire and match referee are not sports person but technical person. So 194 BA not applicable. Sorry, 194 E not applicable. 194 E not applicable. TDS under section 195. 194 E and 115 BBA. Okay. TDS under 195 is required to be deducted. Fine. Yes. Is it clear? Any doubt? Any question? Any doubt? One more case is in respect of, this is a recent case in Pilcom. Now the ICC, you all watch the World Cup, right? The International Cricket Council has its headquarters in London. Now this is the organization which set the rules for the game of cricket, right? Now there was a special meeting of ICC held in London in the year 1993. And India, Pakistan and Sri Lanka were chosen to co-host the World Cup. At that time, you have not even born and you have not even seen that cricket match, right? Now, a joint committee of these three countries, PILCOM, was set up to conduct the World Cup at that point in time. Now, bank accounts were opened by PILCOM in London to operate jointly by the India and Pakistan Cricket Board. Now, in this account, the monies were deposited from all the sponsorships, all the TV rights, whatever was received. And BCCI, Board of Control for Cricket in India, BCCI appointed its own committee, INCOM, for discharge of the functions. Now, INCOM had the bank account here in India. Now, from the bank account of PILCOM, certain amounts were transferred to the bank account of INCOM for the purpose of payment to the umpires, referees, admin expenses, payment of prize money, right? And PILCOM paid some amount as guarantee money to the cricket associations. Now, the payment of the guarantee money paid to the board of different countries were in the nature of the guarantee money paid to the non-resident sports association. The payments were not directly made in India, but through the bank account in London or in different countries. Now, these non-resident sports association had participated in the event which was conducted in the country, where the cricket teams played these matches. Now, this guarantee money were intricately connected with the event where various cricket teams played and participated in the event. The matches were conducted in India. So it was held that the source of income was in India. And 115 BBA will be applicable. So in this particular case, the Supreme Court answered that 115 BBA requires that if the total income of a non-resident sports association includes the amount or income from any game or sports played in India, include the amount guaranteed to be paid or payable in relation to any game or sports payable in India or played in India. Amount guaranteed, paid or payable from any game or in relation to any game or sports played or payable in India. You can write it here like this. In relation to any game or sports played in India. Now, there is a connection which is established. Now, the amounts which were paid to the sports association, if there is a connection between the game played and the guarantee amount paid, then there could be the accrual which will happen in India. The payment made to the non-resident sports association represented the income which accrue or arose or deemed to have accrue or arose in India, and consequently 194E will be applicable. Are we clear? So this is the PILCOM ruling. You can write that is there in your module. You can just write it over here. Amount guaranteed to the non-resident sports association in relation to game played in India . deemed to accrue or arise in India. TDS under section 194E applicable. Fine. Yes or no? Sportsmen participating in shows? No, that is not a game. If it is a game, that will be covered. Clear, Jacob? If he is an entertainer, then yes. Performance income will be covered. Okay, so we'll stop here. I again request you, please revise. We have done many things. We have almost completed the international tax part. Only the DTL relief is pending, which we'll do in the next class. So thank you so much. See you in the next class.